How to minimize tracking error in commodity ETFs. If you are considering investing in commodity exchange-traded funds, you might be wondering how to ensure your investment closely mirrors the performance of the underlying commodities. Tracking error is the term used to describe the difference between the actual returns of the exchange-traded fund and the returns of its benchmark or index. Minimizing this tracking error is essential for investors seeking accurate exposure to the commodities market. Let's break down some effective strategies to achieve this. First, look at the replication method used by the exchange-traded fund. Funds that utilize full physical replication hold the actual commodities or commodity-backed assets. This method typically results in lower tracking errors since the fund directly mirrors the price movements of the commodities. On the other hand, funds that relying on futures contracts or swaps may experience higher tracking errors due to complexities like futures roll costs. Choosing funds with efficient futures management can help mitigate this issue. Next, consider the management of futures roll costs and the term structure effects. Commodity futures have expiration dates, meaning exchange-traded funds must periodically roll contracts to maintain exposure. If the futures curve is in contango, where future prices are higher than spot prices, rolling can lead to losses and increased tracking error. Selecting funds that optimize roll strategies can help reduce these negative impacts. Another factor to consider is the expense ratio of the exchange-traded fund. A lower expense ratio can contribute to smaller tracking errors. This means minimizing trading costs, management fees, and other operational expenses is vital to keeping the fund's performance aligned with the benchmark. Cash drag is also an important consideration. Holding cash for liquidity can cause the fund's returns to lag behind the benchmark since cash typically earns less than the commodities. Efficient cash management and minimizing idle cash can help reduce this source of tracking error. Additionally, be aware of index changes and rebalancing. Commodity indices may update their composition or weights, and exchange-traded funds incur transaction costs during these rebalancing periods. Funds with efficient rebalancing processes and low turnover can help minimize this impact. Currency fluctuations can also create tracking errors, especially for funds denominated in a different currency than the commodity market. Implementing cost-effective currency hedging strategies can help align returns with the benchmark. Some exchange-traded funds engage in securities lending to generate additional income, which can offset expenses and reduce tracking error. However, this practice must be managed carefully to avoid introducing additional risks. Lastly, when physical replication is not feasible, some funds may use sampling techniques to approximate the index. Using representative, liquid assets that closely match the benchmark's characteristics can help reduce tracking error. In summary, when choosing commodity exchange-traded funds, focus on those with transparent replication methods, low expense ratios, and effective futures management. Monitoring how these funds handle roll strategies and operational factors can help ensure your investment closely tracks the underlying commodity index.